Bonds are crucial tools for retail macro traders, offering insight into economic expectations and allowing traders to strategically express their macroeconomic views. Firstly, understanding the yield curve is fundamental. The yield curve plots interest rates at different maturities from short-term, 2-year, to long-term, 10-year or beyond. Typically, an upward-sloping yield curve indicates expectations of economic growth and inflation, signalling confidence in future economic activity. Conversely, a flat or inverted yield curve, where short-term yields surpass long-term yields, often signals economic uncertainty or a potential recession ahead, as investors anticipate future rate cuts to combat slowing growth. A key indicator to monitor is the 2-10 spread, or the yield difference between the 10-year and the 2-year Treasury notes. A widening spread typically indicates optimism regarding economic growth, whilst a narrowing or negative spread signals caution or recession fears. Traders often track the 2-10 spread closely as a leading indicator for shifts in economic cycles, positioning themselves accordingly in anticipation of market movements. Understanding the concept of credit risk and duration is equally critical. Credit risk refers to the possibility that bond issuers might default on their obligations. Higher credit risk bonds, like high-yield or junk bonds, usually offer higher yields to compensate investors for increased default risk. Duration measures a bond's sensitivity to interest rate changes. Bonds with longer durations are more sensitive to rate changes, experiencing greater price movements when rates fluctuate. Traders balance credit risk and duration according to their macroeconomic outlook, adjusting portfolios to manage exposure to these risks. Traders can express their macroeconomic views practically using bond ETFs or bond futures. Bond ETFs offers straightforward access to diversified bond portfolios, enabling traders to quickly position themselves in various segments of the fixed income market, from government bonds and investment-grade corporates to high-yield and emerging market debt. Bond futures, meanwhile, provide leveraged exposure and the ability to speculate on interest rate movements or hedge portfolio risk effectively. By closely analysing the yield curve, monitoring the 2-10 spread, balancing credit risk and duration exposure, and strategically utilising bond ETFs and futures, retail macro traders can effectively navigate bond markets, aligning their trading strategies with broader economic conditions and achieving improved risk-adjusted returns.